Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. As always, exciting to be involved in the markets. The US labor figures, I believe, were out on Friday. A huge number, about 500,000 new jobs created. The estimate was 280,000, so it's a huge number. So today we're going to talk about asset allocation. Initially, interestingly, we've had an upgrade to the markets from Capital Economics, a slightly more sanguine view from ECR, a little bit more bullish from MRB, and then a liquidity analysis from cross-border capital, which as always is pretty bearish, but there seems to be light at the tunnel, even from Michael Howell. We're going to talk about dividend strategy and how that's appropriate in the current market, and also about the China outlook. So let's move on to asset allocation, starting off with Capital Economics. They've pared back their forecasts for the rise in yields and fall in equities. Investors expect the Fed to tighten policy by less than previously discounted. And this is Capital Economics, and they agree with a general consensus view in the futures market that hikes are likely to reverse fairly quickly after they've peaked. According to Capital Economics, they forecast 100 basis points of cuts from the peak Fed funds rate in 2023 by the end of that year. So it's a pretty aggressive cut in interest rates next year, which should be good for the markets. Previously, their forecast with the S&P 500 for the end of this year, end of 2023 and end of 2024, so this is for the S&P 500, were 3,400, 3,200 and 3,600. Current level just over 4,000. Their new forecasts are 4,000, 4,400 for 2023 and 2024, and 3,600 this year. So it's a considerable improvement. So just to reiterate, it's gone from 3.4 to 3.6 for this year, 2023, 3.2 to 4,000, and 2024, 3,600 to 4,400. ECR, they're concerned that inflation is going to be more sticky than many would hope. Although inflation is likely to decline over the next few months, we expect persistent upward pressure on core inflation. We reduce the allocation to emerging market currencies. So a little bit fleshing out a bit more detail. They think there's a risk of a wage price spiral. They believe that central banks will remain focused on countering inflation rather than worrying about a potential recession. The negative impact of tighter monetary policy on growth has yet to become apparent. Of course, there's always a lag time after a tightening in monetary policy. That will place economic growth under more downward pressure later this year. As a result, corporate earnings will come under more downward pressure. After the summer, the Fed will ramp up the pace of quantitative tightening from the current level of $47.5 billion a month to $95 billion a month. You would not be surprised if pent-up demand for services and tight labor markets ensure inflation hardly declines in the coming weeks, and that core inflation will rise even further. Interestingly enough, they want to increase the allocation to commodities from neutral to slightly overweight. The recent decline in commodity prices has removed a great deal of speculation from the commodity market, and commodities remain an attractive hedge against a scenario of persistent high inflation. Their observation is that it's proving increasingly difficult for companies to pass on higher costs as consumers are less optimistic or cautious about spending. In other words, expect more margin pressure. So ECR expecting the S&P 500 index to decline towards 3,200 over the next few months. MRB, just a couple of observations. They talk about leverage, balance sheets. It's a perennial concern for investors. But aggregate debt levels, although they surged in the developed world during the pandemic, the bulk of the increase in debt was in public sectors at government level. If you look at aggregate debt levels at the household sector, at the company sector, and critically in the financial sector, there in fact has been a huge improvement. So that's good news. We may have further weakness in the markets over the 3 to 6 months ahead, but after that, I think we can expect some decent returns for equity-based global portfolios. Cross-border capital, the liquidity, the latest evidence shows a surprisingly half-hearted quantitative tightening. It was meant to have been $100 billion a month. It's only $47.5 billion. So maybe the Fed pivot from tightening to reducing interest rates potentially isn't that far away. However, they do caution major rallies like the one we had in July are often the most vicious rallies when they occur in bear markets. So reading between the lines, definitely cross-border capital are far more bullish than they normally are. What does one do in trying times? You buy dividend yielding investments. So this is quite an interesting study by MRB, the value of dividend payments in weakening economic cycles. Dividends are more stable than earnings and provide a buffer for equities during periods of weakening global economic growth. High dividend yielding stocks are well positioned to outperform in the coming months, while simultaneously experiencing lower volatility than conventional benchmarks. So we really have been helped a lot with various holdings in the global portfolios like Murray International, also the UK stocks. UK has always been traditionally a very defensive market. A concentration of consumer staple stocks, healthcare stocks, financials, commodity stocks, oil companies. So we've got a couple of holdings there. Edinburgh Investment Trust, Murray Income, both yielding between 3.5% to 4.5%. Over the next decade, we expect dividends to account for the bulk of global equity total returns. Like earnings, dividend payments are sensitive to the economic cycle, but less so, with companies typically reluctant to cut dividends in anything but exceptional circumstances. Looking historically, global high dividend yielding stocks outperformed during the past 3 US recessions. Looking at it differently, at the analysis, the statistics, the annual growth rate of dividends is much less volatile than that of earnings. Indeed, while for most of the past 3 decades, dividends and earnings have grown at a similar pace, the variation in annual dividend growth has been less than half that of earnings. What is the global dividend payout ratio? So the percentage of net profits that is paid out as a dividend, that's a dividend payout ratio. Currently, it's towards the lower end of its historical range and has ample room to rise as economic growth weakens. So a lot of fat built into the system. Just going to talk about China. We did sell out of China Fidelity China special situation some time back. Over the past week, we've trimmed back Templeton Emerging Markets, its biggest holdings, for companies like Tencent, Alibaba, Baidu, and so forth. So MRB has been very bullish on China for a long time, but they seem to be paring back their positive view. They cite China's COVID-0 approach, scattered lockdowns, continuously being imposed across the country, this year's growth target, the official target of 5.5%, is clearly well beyond reach. While China's growth is indeed recovering after a painful second quarter, which saw quarter-on-quarter contraction and an annual growth rate of just 0.4%, the pace of the recovery is far more modest than was hoped for just a month ago. The MRB Economic Activity Indicator is growing substantially below trend. The Citigroup Economic Surprise Index recovered from deeply negative readings to neutral in early July, but it has now slipped back to negative territory. There's a cavalcade of recent unsettling economic news. First, a run on rural banks with extraordinarily harsh responses against depositors from law enforcement. A widening mortgage boycott by homeowners unhappy with delayed construction projects. Continuing feeble consumption data, i.e. retail sales, online sales, auto sales. And last, the unpredictable nature of COVID infections and the potential rollout of further lockdowns. All right, guys, that's all from my side. Gielie, how's it looking on the local markets?
I thank you, Nick, for a very comprehensive macro overview. Very interesting, very nice. Thank you very much. On the local side, then Raubex, they announced that the chairman of their board, Fred Kenny, has resigned with effect from the 5th of August. So he's already out. He's been with the company for over 20 years, and the reason for his resignation is just two personal tragedies that he suffered in his family. And he's an elderly gentleman, so he decided to leave. News from Investec. We hold Investec. It's a new one. They announced that they are budgeting 2 million rand for each executive's protection. And the reason for that is due to the concerns about South Africa's rising crime levels. So it's costing Investec 2 million for each executive director. Not all directors, only the executive ones. Sasol, we own Sasol. They released a trading statement for the year ended June 2022. And they expect profits to increase between 8 and 28%. It's a very wide range, but that's what it is. MTN, we own MTN. They had a 6 months update, and they really delivered a very resilient performance in these 6 months. They expect headline earnings per share to increase between 40 and 50%. And foreign net selling of shares on the JSE year to date, it now stands at 53 billion rand. It's quite a lot. If it's now 53 billion rand, you can expect it to follow a straight line. It could go to 100 billion for the full year. It's nearly 2 billion per month. It's quite a lot of money that's leaving the country. Statistics, Absa's manufacturing PMI, it came down, unfortunately, from 52 points to 46 points. Our foreign exchange reserves for July went up from $58 billion to $59 billion. And then car sales also came out at the 1st of August. The vehicle sales, the local vehicle sales, was 43,593. It's up 30%. And exports were up 177%. That's very nice. Thank you very much, Nick. That's all from me.